Thank you very much. Thank you to the organizers for including me in the program. This is probably not the best time. I feel responsible to keep you awake, but I'll try my best. I'm particularly delighted to be here today celebrating Jerry's career. Like Leora, Jerry was my first boss when I completed my PhD, and really I could have not asked for a better boss. Jerry was a role model to me in many important ways. He, as we probably all of you know, he has a keen sense for policy, and his research pipeline was always very policy relevant. Moreover, he can communicate research in a way that researchers can appreciate, but also policymakers can understand and benefit from. And finally, but very importantly, when you're starting out, he exemplified work-life balance. He worked extremely hard, was a very dedicated researcher, but at least as far as I could tell, he would always make time for his family and for his hobbies, which I think still include playing the guitar. So as a fresh out of grad school economist, I really learned a lot from Jerry's qualities. He was also a very nice and caring boss. So I'm very grateful to Jerry for for making the early years in my career both formative and enjoyable. And what I'll try to do today, I hope, is in the spirit of Jerry's work, which includes very detailed data collection and also trying to get into questions that are policy relevant. So I'll try my best not to disappoint Jerry and the audience, of course, and all of you. So the usual disclaimer applies. Oh, sorry, I should have said the title of my paper that I'm presenting is What Policies Combinations Worked? The Effects of Policy Packages on Bank Lending During COVID. And this is joint work with my colleagues Divya Kirti, Prachi Mishra, and Jan Strasky, who since then is now at the OECD. And the usual disclaimer applies. These are my personal views, and those are my co-authors. Anyway, so hopefully I don't have to motivate too much about what happened during COVID, why we cared. Obviously, it was an unprecedented shock. On the left, I'm showing you the revisions to output predictions that the IMF made in 2019 relative to what happened in 2020 and 2021. And so this graph tells you the number of countries that experienced revisions in GDP per capita of the orders of magnitudes on the x-axis. So for most countries, the shock was very significant. It was over 10 percentage points revisions in output, so very, very significant. Different from previous shocks, in particular the global financial crisis, this did not start as a financial sector shock. And in fact, after the GFC and the waves of reforms that came, financial sector reforms, I guess policymakers were feeling very good about the resilience of the financial sector. Yet, despite all this, there were also significant effects on bank credit. And this is what I'm trying to show you on the B chart, where I report quarterly credit growth. And you see that credit growth at the start of the pandemic, before policies came into effect, really plummeted, and it plummeted across countries. So what we try to do in this paper is to provide an assessment of the effectiveness of economic and financial policies in supporting bank lending during the first year of the pandemic. And importantly, how we will distinguish ourselves from other papers is that we're going to focus on the combination and the size of policies. And I'll say more about it and why we do this in a little bit. We also want to explore heterogeneity because, of course, not all banks are equal. Not all banks came into the pandemic in the same way. And so we would expect that their degree of health would have probably impacted the need and responsiveness to policies. And so that's one thing we're going to look into. Also, part of why credit was supported, and I'll say more about this as well, was to support firms and households, right, weather kind of the pandemic. And so we want to look at how this increase in credit, to the extent that it materialized, translated into a capacity among firms to withstand the pandemic, and in particular meet the expenses that they had to meet during the pandemic. But one concern that we want to address is to what extent there were misallocation. And a lot more can be done on this, but at least we try to scratch the surface, right? Because one concern might be, okay, there were some firms that went into the pandemic that were probably not doing very well. Did these firms disproportionately benefit from the support that the policies provided and the increase in bank credit that came as a result of these policies? So we're going to try to say something about misallocation, if you will. So why focus on bank credit? You know, there are a lot of other things that the pandemic affected in terms of, in economic terms, right? And I will allude to papers that I won't focus, but allude to a broad literature on what happened during COVID. But the reason why we focus on credit is because in a way, credit was an important intermediate objective, right? Was a way in which policies could provide the liquidity that households and firms needed to weather their expenses during the pandemic. And so this is why we think, you know, it's important to look at what happened to credit. And when we think about how could policies have affected credit, we like to think of 3 dimensions or layers. So on the one hand, there is the extent to which policies could shift bank incentives at the margin. So think about, for example, grants. Grants are things that both households and firms received, which could then, they could use to meet some of the payments, including payments to banks to which they owed money. And so the fact that this might lower the probability of borrowers' default would have an incentive on banks to lend despite all the uncertainty, right? Policies like guarantees could also affect incentives because they lower the loss given default that banks might face. At the same time, there are policies that could affect the constraints that banks face and the capacity to lend. So, you know, banks might have gone into the crisis with high capital requirements, low liquidity, for example, and other kinds of restrictions that might have not allowed them to increase lending. And so policies that relax these constraints and build capacity to lend, let's say credit facilities that banks could benefit from the central banks, you know, had an impact, obviously, or we would expect would have an impact. And at the same time, any kind of policies that is supporting aggregate demand would, of course, affect observed credit because they are raising borrower demand for credit. So we think that because policies act in different layers or different dimensions, when we think about what mattered for credit, it's important to think about broadly across policies, not just to focus on specific policies. I mean, of course, research on specific policies is very useful, and I'm not going to deny that. I'm just trying to say that I think there's an angle to looking at broad policies and combinations of policies that is important given the different ways in which policies can affect credit. Okay, so on the literature, as I said, there is a vast literature that has come out, you know, during COVID and after COVID, looking at different impacts of the pandemic on labor markets, on, you know, corporate sector, stock returns, you name it. Here I'm just referring to the literature on bank lending because that's what we focus on. And there were very good and well-published studies that have looked at specific policies on bank lending for the US. A lot of attention was drawn by the Paycheck Protection Program in the US. So there are very good studies that have looked at, you know, which were the banks that lent and who did they lend to. There were also a lot of excellent studies focusing on guarantees. Guarantees were, you know, very important, in particular in Europe, and there are excellent studies that have looked at the effectiveness of guarantees. But we find a lot fewer studies that really look across policies. There are some, those tend to be focused on the euro area, and they mostly are calibrating models based on past episodes to predict what could happen if certain policies were implemented. So the way we see our contribution is to try to, as I said, highlight and look at the impact of different policies, how they were combined, what were their sizes. I'll say more to this. And so, you know, to our knowledge, we are the first that attempt to do this. Now it's working, I don't know. So important for this analysis is, of course, understanding what countries did. And we know that the response to the pandemic was very fast and very comprehensive. And we started looking at what data sets were out there. So the fund had quickly put together a very nice but descriptive tracker of policy. So there was a survey that went out to the different country desks asking them, okay, what did Nepal do? What did South Africa do? And so there was a narrative to this. But it wasn't great for research, because for research you need a lot more detail and also a lot more structure to the way this information was presented. There were also other trackers. For example, the ESRB in Europe has a very comprehensive tracker for EU countries, but EU only. There were efforts by the BIS to look at monetary policy responses, but only monetary policy responses. There was the Yale tracker that is quite comprehensive as far as country coverage, but less so on the granular policies that were implemented. So we quickly realized we're going to have to collect our own data. And we spent a lot of time doing this. We end up with this comprehensive data set that is detailed in a separate paper that's called Tracking the Economic and Financial Policies During COVID, an announcement level data set. That paper has the data available online, so for any of you that want to play with it, it's available there. It's a daily announcement level data set that includes 28 granular policies adopted by 74 countries. We only focus on the first year because, as you can imagine, this was not easy to do. And we see that the sharp decline in credit really happened at the very start of the pandemic. So this is why we focus on this. We end up with a tracker that has 5,500 policy announcements across. We will look at across 3 dimensions: monetary, prudential, and fiscal policies. And so this just gives you a sense of, quickly looking at these policies, we realized that a unique feature of the COVID experience was that policies were announced in packages. There were rarely weeks where only one policy was implemented. There were a lot of policies happening and they were simultaneous. And so part of our interest was to understand, okay, what was happening, which policy combinations were most widely used, and which ones were more effective. Did it matter if you only did fiscal policy or monetary policy, or did you have to, combine 2 types of policies? And for this, this was important to us because it relates back to what I said earlier about how we would expect policies to matter. And it's across different dimensions, and so this is why we felt that combinations were important. So that's kind of going to be the goal of this. So for fiscal policies, let me just give you a sense of what are we looking at. We're looking at grants, tax reliefs, tax deferrals, guarantees, public loans, equity participations. For monetary policies, we're looking at rate cuts, changes in reserve requirements, asset purchases, credit lines, swap lines, FX interventions. For prudential policies, we're looking at changes in buffers and capital requirements and borrower-based measures and dividend restrictions and reporting requirements, lending standards, provisioning guidelines, so a whole host of different policies. And all of that, if you're interested, you could see in our data set. So now that we have this data of policies, what we do is we combine it with bank-level quarterly data that we get from S&P Capital IQ for 1,500 banks in 49 countries. And this is, again, quarterly data. And our baseline estimation is represented here by equation 1. And very simply, what we're doing is on the left-hand side, we're trying to look at the change in credit over the quarter. On the right-hand side, we want to look at P or packages, and we're going to look at different policy combinations. We're going to either use dummies for these policy combinations, or we're going to use counts of the policies within the policy packages as a measure of intensity of how much was done. And then we're going to look at size buckets as well for policies. But of course, policies weren't the only thing happening, and so we need to account for controls. And so we here basically look at de facto mobility from Google. We look at health development, number of cases per capita, COVID cases. We look at kind of revisions to GDP and sort of what was happening at the economy level, and then also measures of financial stress, because all of those could of course, affect the policy choices, but also directly affect lending. And we also want to account for differences across banks in their size, in their capitalization levels, in their asset and liability composition, so that's the X variable there. And then we have bank fixed effects. And then I'll show you when we get to heterogeneity, we can also control for quarter country fixed effects, so we can make it a lot tighter identification-wise. But here, one concern might be reverse causation, right? That kind of loan growth could affect policy package choices. Some of this might be mitigated by the lagging, but the way we try to defend this is also by saying that if there were reverse causation, that would bias our estimates downwards. So at best, what we report here, to the extent that it's biased, is a lower bound of probably the true estimate. So let me just get to some of the more important results. And here what I try to show is the count of policies across policy packages. And why do we focus only on these policy packages when earlier I showed you many more combinations? The reason is that those combinations were very, very, no policies is 4% of the sample. Only certain policies is 3% of the sample. So in these regressions, it's in the omitted categories, basically. Because there were rarely instances where fiscal policies were not implemented. So most of the times when monetary was implemented, fiscal was also implemented. So here we're trying to look at the packages that were observed significantly in the data. And what we show you here when focusing on the count of policies, so for each kind of package, we want to know how many policies, how many fiscal policies were there in the fiscal-only packages, how many fiscal and monetary policies were in the monetary-only, of course, dividing by the fact that there you can have at the very least 2 policies, right? And in the packages that have 3 combinations, you have 3 policies potentially to make it into that package, so we have to account for that. So we look at the counts over the total maximum of policies or minimum of policies you could have to belong to a package. And what we find is that really what seems to have an effect on credit, once we control for all these other controls and we look at all the other packages, is when countries did fiscal, monetary, and prudential. So it wasn't enough to do fiscal, and it wasn't enough to do fiscal monetary really to get an impact on credit. It's the countries that implemented, the countries in the quarters that implemented these combinations. And we get that an extra policy gets you 44 basis points increase in quarterly credit growth, which is significant considering that credit growth, if you start in 2019, was 200 basis points per quarter. So this is a sizable impact. Now, if we look at this is just showing you a picture, a regression, where instead of looking at counts, I'm now going to look at the size of policies. And for this particular one, I'm going to restrict large to be cases of policies that are in the top decile, so very, very large policies. And this is also why you don't observe all the combinations, because there weren't that many with this classification of size. And again, what's clear from this is that you needed all 3, but by itself, that wasn't enough either, because here I'm comparing fiscal, monetary, and prudential to fiscal, monetary, and prudential large, and you see that you needed it to be an all-out approach. This is what we call an all-out approach, meaning one where you did all 3, you kind of tackled all the different ways in which policies could affect credit, and you did it in a sizable way. And sizable here is basically the top decile. But if you look at tercile, which also allows us to give more granularity to the observed policies there, it's interesting because here what we see is that, again, it's the scope and the size together that matters, because now I can break it up and look at fiscal, monetary, and prudential policies. Fiscal, monetary, and prudential where one policy is large, and compare that to fiscal, monetary, and prudential, well, all are large. And again, all of the action seems to be coming from those combinations. And there we see that it's, again, sizable because countries that had these 3 combinations and they were large had 6 percentage points faster loan growth in a quarter. Sorry. So what was the makeup of these combinations? What are we talking about here? What did countries do when I say combinations? So for example, if we look at the combinations, the policies that were most prevalent in packages that combined the successful policies, if you will, the ones that had all three and were large, what we found is it was about grants, it was about credit facilities on the monetary side, and it was about relaxation of capital requirements or buffers on the prudential side. These were the tools that were most employed in the packages that we found to be most effective. On the other hand, policies like equity participation, changes in reserve requirements, changes in lending standards were less prevalent. We don't see those as part of the packages that were most effective. Now, of course, we need to do some robustness analysis here. And so what are some of the concerns? So one thing that might be coming through your mind is, well, is it about the fact that you announced the policies together, or is it the fact that over the quarter you ended up having all kinds of three? So do they have to kind of be announced together? Or is it about, okay, at the end of this quarter you did all three? Was there something about new policies as opposed to the accumulated stock of policies that matter? And so we tried to look at this. Unfortunately, our data at the policy level is very detailed. It's daily, but our bank credit data is quarterly. And so there's a limit to what we can do. But we tried to address this issue by looking at the number of weeks when different policies were announced. So we look at weeks with one type of policy being announced, weeks where two types of policies were announced, and weeks where three types of policies were announced. And we see that, that's where we get most of the action, that in those weeks is where we see credit growing more in our data. So this would suggest that it's really the new policies and not the accumulated stock that seem to have mattered. We also look at different cuts of how we define large. So I showed you two. We looked at deciles, terciles. We also looked at the median. It didn't matter. We always ended up finding this effect of large policies. You might also be concerned that, oh, maybe there's a base effect, like if credit is rebounding from a low point, does that matter? And even when we control for lag credit, our results still remain. You might be concerned that, oh, well, the number of banks might be different across countries, and so most of your effects might be coming from a particular country that has more banks. And so we try to address this by doing weighted estimations, and we don't see that changes our results. Okay, so very quickly running through the other kinds of things that we try to do beyond our baseline. So I alluded to this at the beginning. So the first thing at the top is we try to look at the interaction of our packages with the variable omega B. Omega B really is an indicator of sort of the capitalization, the constraints that banks might have faced at the start of the pandemic. And of course, we also need to control for the interaction of the other controls with omega B because we don't want confounding effects. And one nice thing about this equation too is that we can also control for country quarter fixed effects. And that then gives us some more comfort that, anything else that happened on the country quarter level beyond the policies being implemented is now controlled for. And I'm just going to summarize the results. I have the tables, but in the interest of time, basically we find that this all-out approach that I've been discussing was really more effective for low equity banks. So those were the banks that had constraints to lend, and so those were the ones that benefited the most as far as being able to increase credit during the pandemic. Now, switching to the firm side, which is what I do in 3 and 4. So in 3, I'm going to look at this variable E, and that is how many months of expenses did the change in credit allow the firm to finance. And this is going to be a measure, if you will, of liquidity for the firm. Like it can meet many more months of expenses if it's able to access credit. And I want to know whether packages had an effect on this, and in particular where it had an effect on this on what I'm capturing by omega F, which is bank-dependent firms. Because of course, for firms that do not borrow from banks, then the policies that help credit are not necessarily going to be relevant for them. So we look at the interaction of the packages with the measure of bank dependence, and indeed we find that the packages channeled additional liquidity to more to bank-dependent firms relative to non-bank dependent firms, as we would have expected. In the last equation, I introduced this triple term where you have a QF, and the QF are indicators for quality of the firm. So we look at, in 2019, were these firms of high quality or low quality? Well, we actually focus on low quality, and we're going to define that as firms that had low interest coverage ratios, so basically had difficulty paying their debts, had low net worth, low equity, had low returns, and higher distance to default. And regardless of which indicator of quality we don't find that the triple interaction matters, meaning there's no, at least that we could find, no evidence that while yes, liquidity favored bank-dependent firms, it did not seem to differentially favor those of low quality, at least as defined at the start of the pandemic. So these are the results. I just thought it was better to talk about them qualitatively, but you can see them there or in the paper. Let me just conclude. So loan growth, we find, was faster in countries where authorities went all out. I alluded to this several times. So again, it's these combinations of policies that are large. Across banks, the impact was larger among the banks that were initially more constrained. This credit did help bank-dependent firms. It provided greater liquidity, greater ability to meet their expenses, and we don't seem to find evidence of a misallocation in the sense that the firms that were lower in quality were disproportionately benefiting. Now, I have to end by saying, of course, the takeaway was like, well, next crisis, we go all out, right? And maybe for COVID, there was no other way. But we have to recognize that there are costs and unintended consequences, and also ability to do this, right? Because for countries that have little fiscal space, going all out might not be possible. But even if it were possible, would we always want to do it? And we have to recognize that there are costs, both in terms of, for example, now debt sustainability concerns, because for many countries, fiscal expansions were very large. And there could also be other consequences like inflationary pressures, like we see now in many of the advanced economies, which in fact, were among some of the ones that had the largest policies. So the challenge, these results are very interesting, at least to me, but the challenge is in the calibration. Like in practice, what does that mean going all out? How can you sort of support credit, support the economy, but at the same time, have a handle on the unintended consequences, the costs that will come subsequently. So let me stop here and take any questions. Thank you.
Hello, thank you for your presentation. So I just have two small questions. So you say that in your research you are take into account the heterogeneity in your sample, but I'm not so clear about that. Can you explain a little bit more about how can you do that? And the second question is about, because when the central bank or the monetary authorities, they make the decision, they also have to look at the development of the market. So I think that's one of the leading indicators will be the credit growth. So how about the endogeneity? I mean the reverse causality from the feedback information from the credit growth to the fiscal, to the monetary policy authority when they're making their decision. Yeah, thank you.
Yeah. So to the last point, I alluded to this when I said that, we're trying to lag policy, so we try to look at, okay, you took a policy yesterday, what was the impact on credit? But we recognize that as far as identification, this is not the greatest way of doing it. And frankly, we tried different ways of approaching instrumentation, but it's very difficult because the typical things we would do, like synthetic controls or things of that sort, are not possible when the shock is global, right? You're not going to have controls, countries that you could use as controls. So the best thing I can say to your concern is that to the extent that there is a bias, it's going to be biasing our estimations downward. because it would basically mean that when credit is low, you want to support more policies, but on the direction that we care about, more policies would mean more credit. So if anything, it just biases our estimation downwards. But I acknowledge that one might be concerned about this, and ideally, we were too, and we tried our best to see if there was a way in which we could mitigate this. So I think this is why many researchers, academic researchers, go for the individual policies, because there sometimes you can find who was eligible, who was not eligible, and identify those policies very precisely. And there's a lot of benefit to that kind of research. But we feel like in an organization like ours, we have to be speaking to other questions that sometimes might be challenging to tackle, but also very interesting. And so we try to the best of our ability to do that in our estimations. To your first question about heterogeneity, well, two things. We are looking at 49 countries, so there's a heterogeneous sample of countries that we examine. That's the best we can do with the data available. So our tracker looks at 74 countries, but the limitation is on the bank credit data, and that was only available for 49 countries. So there's heterogeneity in the sample. And then the other thing I try to allude to is that both in the bank estimations and in the firm estimations, we try to look at how the response might have been different for different kinds of banks, depending on the constraints, in particular on capital, but the results are similar if we look at liquidity. And also when we look at these different indicators of quality of the firms. So we try to address some of the heterogeneous effects in that way as well.
Hi, thank you for your presentation.
Yes.
In one of your conclusions, one conclusion says that loan growth was faster in countries who did the all-out package, right?
Yeah.
But I was wondering what about the quality of these loans distributed during the COVID times? I know it's very recent, but can you talk more about, or can you say more about the quality of these loans? What is your expectation on that?
Yeah, so the last part I showed, which looks at the bank level results, tries to get at that, right? Because one concern might be, okay, you have banks cranking out loans, not really discriminating, and maybe potentially giving all the loans to bad firms. Because one thing that was really challenging at that time was also to understand who was a viable firm, who was not a viable firm at the start of the pandemic and also going forward, who might be viable and not viable going forward, right? So the way we try to get at your question is by looking at the effects on firms and whether we see that disproportionately firms that were of worse quality, whether they benefited more. And we don't find that. So we don't find evidence of that. So, that would tell us that at least from an allocation perspective, it doesn't seem to be the case that banks really allocated lending to the worst kinds of firms.
Thank you for your presentation. 3 small questions.
Yes.
The first one is about your econometric models. I saw that you have, like, on the left-hand side, delta L. What I expected was to have just L and maybe L sub t minus 1 on the right-hand side with a coefficient to account like a kind of inertia on your lending. That's the first question. The second question is about your term span. I don't know how many quarters you consider for your study, because I guess with a very short time span, given that the COVID occurred like 2019 to 2021, you should have a very short or a small degree of liberty. The third question is about, I also expected to have a policy about governments funding like a banking system, given that you are talking about credit. So you just discussed about monetary policy, fiscal policy, but I thought it was also interesting to capture the effect of the policy will consist to just flow some credit to the bank system. Thank you.
Yeah. Okay, so on the specification, so we choose to look at the change in lending, but as I said, we also do results where we control for what was credit like the quarter before. So we care about the change, but we also acknowledge that there could be base effects, and so also control for the level of credit the quarter before. The time period is short because we're really looking at 4 quarters across these countries. So that's, by the nature of the data we collected and we had available, what we were able to do. As far as your third question, which was about whether there was just credit to banks, I understood. So that is captured by, in fact, one of the most frequently used policies were credit facilities, right? So facilities that the central banks made available to banks so that they could borrow from the central bank at very low rates, get the additional liquidity that they needed in order to support lending. So that is captured among the policies that we look at. So when we say monetary policy, we're not just looking at policy rates or changes in asset purchases, but we're also contemplating facilities that go to support lending. And also in the fiscal side, we also consider public loans, because in some cases there were direct loans from public institutions to banks or to firms even. Yeah.
Thank you. So this is a very interesting idea, the all-out works, and I'm wondering why all-out works, and have you thought about maybe what's behind this? And I'm thinking if there could be 2 things come to mind. One is it could be a signal that all the agencies, the semi-independent agencies of government, are working together, so that's a signal that's stronger than if only 2 of them, the other one is holding back. But there might be a kind of different one, which is it's a very unusual crisis that the banks in many countries may have felt we are constrained on all fronts. We're constrained on our capital. We're not sure we have enough capital. We're constrained on where will we get the funding. And will there be any demand out there in the economy? And so in this unusual crisis, they're looking at all those 3 dimensions, whereas in another crisis might come along and it might be a more straightforward crisis, and you wouldn't need to go all out, and it might be a big mistake.
Yes, so I agree completely, Patrick. So I think you have to look at the nature of the crisis and the nature of the constraints that banks face. And in my one of the first slides where I alluded to how policies might affect bank credit, what are the levers, if you will. Our sense is that you needed to kind of touch on all the levers, right? You needed to incentivize banks, so you needed policies that incentivize by reducing probability of default, by reducing losses giving default, but you also needed to increase banks' capacity to lend via liquidity, and you also needed to support aggregate demand. So in this kind of crisis, this was needed, and I think it's incumbent upon policymakers. I wouldn't say, take this and do it in every crisis. That's not the point, right? So in this crisis, we talk about these layers of constraints that banks faced and why we feel like all of them need to be relaxed, and why then this goes back to the need for the all-out approach, both in terms of the span, but also the size. One could argue maybe next time, if GDP doesn't fall by 10%, I don't need to go all out on the size, right? So, while we think that there are lessons to be learned here, some of the lessons could be about how this crisis is different than the next one that I'll face, and whether I need to worry about policies that touch on all the levers, and whether I need to worry about size in the same way. So, but I guess I buy more the interpretation, your second interpretation relative to the first interpretation about coordination across agencies, though it's great when we see that, I don't think that was as important as the second element.
Time for one last question. Quick one.
Hi, my question is related to Bill Gates' question. So, okay, the all-out approach worked, right? It was able to increase the credit. But if we account for the bad loans that are coming out now, and it might change the benefit, what net benefit we got. So do you think that this will change the policy, or maybe change the conclusion that all out is better, or only fiscal is better, or only monetary is better? if we account for those bad loans?
Okay, but we have to define what we mean by bad. Because I think by bad, I mean, so you, and again, also the time period.
Let me clarify here. Bad loan, usually what happens, it comes to the surface after maybe 2, 3, 4, 5 years, right?
I understand.
So we have to take that into account.
Yeah, but here's what I mean by defining what is bad. So I understand that bad is a loan that then the debtor cannot repay it. But the question is, at the time that that loan was made, was it a bad loan in the sense that the bank had an indication that that firm was bad and still went ahead with the loan? Because that's a misallocation problem. I think it's different than the problem where, you know, one of the characteristics of this COVID, which is also different from potentially other crises, is the extent of uncertainty. So one thing is to ask the bank, okay, don't give it to a firm that was already known to be bad, even before the pandemic. And another is, can you really distinguish who's going to be good and who's going to be bad going forward? That is a much harder task for banks because, you know, at that time, we didn't know, right? Who was going to survive, which industries, which sectors. And so a lot of what we might see is, yes, I mean, there might have been exposed some concern about allocation, but, you know, ex ante, I don't know that banks could have done any better. I mean, maybe in some countries, I'm generalizing, but I'm saying, you know, we don't like banks giving loans to zombie firms. That is bad and it should be preventable. But it's much harder when uncertainty is high to ask for banks not to be able to at times make mistakes in terms of who they give loans to. And of course, we also should recognize that now we are in a post-COVID world, which is not a recovery world, which is also a world where rates have increased, where there are all kinds of other things going on that could also affect, you know, the ability for firms to pay back their loans in a way that, you know, banks might not have anticipated you know, when they were making these loans in times of COVID. So I think it's, you know, what I'm trying to say is that we want to avoid defaults that are clearly preventable, where the bank should have known, from defaults where, you know, things change down the line, and maybe some of that the banks could have thought, you know, oh, we're going to go into inflation and, you know, maybe have anticipated some of this. But I think it's much harder to say, oh, you know, ex ante, these were bad loans. I think a lot of things happened, and you also have to concern yourself with how many bad loans would you have had the economy not recovered, right? So that's the counterfactual also from this. So the calibration is very tricky. I don't want to say, oh, go all out in all cases, and, you know, I don't know what exactly it means for each country. But I think we need to keep all these considerations in mind. So I don't want to take more time. I know we are.
Thank you. So your concern when you started was, you know, will you be interesting post-lunch? You passed that hurdle by a huge margin.
Okay, I'm glad.
Thank you for a wonderful talk.
Thank you. Thank you.